Hello, my name's Richard Colwell from Columbia Threadneedle, responsible for the Income Fund and the UK team. Thank you very much for this invite. I've got a few slides to support what I'd like to sort of say, flying the flag really for UK equities and what I think is a very exciting opportunity, as extreme as it was coming out of the financial crisis nearly a decade ago actually. So my title of my presentation that I put together is already out of date. I'm pleased to see that I've sort of said we were in need of a vaccine. So hopefully the Pfizer vaccine that was just announced prior to filming is the first of many. So I know, slide behind me, obligatory yes Prime Minister quote. You can always find the appropriate one for any given moment in our political backdrop over the last 5 years, I find. So although we're all emotional, fed up, frustrated, with this sort of doom loop that's going on and beating up our politicians, which is understandable, but we shouldn't lose sight of the fact that as investors, this isn't a sort of a popularity contest. It's not about who's got the best government or the most conviction in their policy to COVID, and the ups and downs emotionally over negotiations over Brexit and the policies over COVID, shouldn't detract from what's staring us in the face, which is great valuations across the spectrum in the UK markets, that companies that are listed in the UK, minding their own business, international businesses getting on with stuff, pound for pound, are on a double discount really, versus if they were quoted in the European stock market or certainly in the US stock market. And that's a real frustration that we've just seen relentless asset allocation away from UK equities over the last few years. And as a consequence, if we, the investment community, continue to follow the herd in that respect, then we're just presenting a great prize for private equity buyers or overseas corporates to come in and exploit this valuation arbitrage. So, we at Columbia Threadneedle, we're investors, we're not renters of stocks, and we're wrestling really hard, working with the boards of companies that we own sizable stakes in and their advisors to try and shine a light on the intrinsic value in their businesses, whether it's through disclosure, through disposals of divisions, just to show what the rump value of a business is. And of course, through COVID, we want to make sure they can swim across to the other side of the shore. So we've been very involved in support for fundraisings to ensure businesses have the liquidity that they need to come out fighting, to make sure that they preserve their muscle and can compete with rivals that are more debt laden. So it's a very exciting time actually over the last sort of 6-9 months. Very lively, lot going on behind the scenes, and it's really frustrating that share price movements are seen as evidence that the UK is just full of rubbish companies doing rubbish things, and that's not the case. It's really frustrating that sort of opinions seem to follow share prices rather than the other way around. And we've got to think further afield. What will you be experiencing at the end of 21 going into 22 economically and about businesses? And rather than being fixated on the mark to market and what's going on day to day, I think that's really important. So, it's sort of, after coming out of the first lockdown emotionally, going back to my first comment, everybody kind of were putting the shoulders back, thinking, well, maybe we'll get back to some sort of normality, etc. And we'll have a catch up with sort of global stock markets that have done so much better than the UK. And then in early September, everybody just went, turns out the light at the end of the tunnel was just another train coming. It's like, And so we just got to sort of get away from that, take a step back from the screen and be very aware of the valuation prize that is there. So I mean, the next slide show you that it goes back to the summer actually. So in the States, the Economist ran with the Bezos as their front cover, and in the UK they did the one with our beleaguered flag, and that kind of sums it up really. And you might think, well, what's a UK income manager even making any reference to the US about? But it's very important. It is linked that we're in a very extreme polarized market, and it is all about growth and vision rather than valuation. So we all clearly know that we're going to have an Amazon COVID Christmas, and Bezos is professor of Cunning at the University of Cunning, etc., and is now personally wealthier than Qatar, I think. But it's not about the narrative. It's the fact that globally investors crave that good news, that momentum, etc. And so all the hedge funds that are long the big US tech giants, they're short the UK equities. We're the mirror image of that trade. So every time their longs kept going up to keep their net positions aligned, they were making the UK even shorter positions, more aggressive. And there's these basket trades that wash through the market. It's a very technical market. So on the day of the Pfizer vaccine news, now clearly there's plenty of practical issues to overcome logistically in launching that, let alone any details on the safety aspects of the vaccine. So the magnitude of movements that you saw in rotation, it was the worst day in 20 years for that sort of quant basket of momentum stocks globally. And the COVID victim stocks were up 20%. But funnily enough, over the last 12 months, the COVID winners were up 140%. So it's very extreme. So the magnitude of the movements and the rotation on that day was because of this technical. There's a lot of hedge fund. Everybody's pointed in the same direction, and it's anti-UK, anti-Brexit, anti-COVID stocks, and it's all about the news flow rather than what's the valuation, what's in the price. And so you get overshooting on the way up and on the way down. And I know all of us UK investors were telling you a year ago, I'm sure at the last year's conference, oh, we're really cheap, we're unloved. And you go, yeah, tell me the other one, I know all that. And here we are a year on, even cheaper, even more unloved. So, am I King Canute? And I think it's just that trends do go on for longer than you think. But that doesn't invalidate the message that you were hearing last year, but it's just amplified even more so. And as people give up on the asset allocation on individual stocks, the prize is that much more amplified. So I mean, that's, I'm sure you've seen the charts behind me before, that sort of sums it up, what I've been talking about, that this is dated to end September. So hopefully it'll switch around quite quickly over the next few months. But, it's a bit rude really that on the left-hand side, you can see through the COVID crisis that we've managed to underperform every equity market other than Brazil and Russia. So that almost looks like it's a popularity contest of who's been the most incompetent over the COVID crisis, and that's not what equity markets should be. And the sentiments from the Bank of America survey on the right. So even though we've underperformed and we've got this valuation attraction, you can see the sentiment is still beleaguered. We're rock bottom, and it's a momentum trade. And can we see a rotation out of that? And everybody says, well, what's the catalyst? What's the new? Well, you can't wait for certainty. You can't wait for everybody to have had their vaccine. By then, the market will have moved. We should be looking ahead, and it's that. Times of great uncertainty, like coming out of the financial crisis, that gives the best opportunity. So it's not about market timing. It's about leaning in and going against the crowd. It's a nice contrarian call to be looking for ideas in the UK market. And it isn't all about a narrow part of that market, the COVID, the Brexit victims, that gives you good optionality, but you're not going to put all your chips on black there necessarily. But you've got to be brave and have some exposure to those sorts of stocks. But it's also in some of the international, more quality growth stocks actually trading at a discount to their peers overseas, as I say, because of that weight of money that's come out of the UK stock market. And so those valuation charts, which again I'm sure you saw a year ago, so I've had to get the pencil out and draw the line a bit lower. Can it go any lower? Well, I suppose it can go over the page, can't it? But you can sort of see on a variation of valuations that we're certainly as cheap as we've ever been relative to other markets on a combination of classic ratios since I started my career in the late 80s. And I think on many measures we're as cheap as we've been since the 70s. Now the comeback is, that's because the UK is just stuffed full of rubbish like oil and banks, etc. But even on the right, you can see, strip out those parts of the index and we're still cheap. So that's got to give us a chance. That's got to be interesting. It's a weird world where we've had this violent V-shaped recovery led by the mega cap tech stocks in the US. And in the UK, we've just missed the party. Prior to this rotation rally on the Pfizer news, we'd got back only about half of the losses from the March-April sell-off. So that's fascinating, and that already we're starting to see bids, despite clarity still awaiting on Brexit. So we big owners of RSA, that they've had approaches. Stocks I don't own, but it's interesting, the William Hills and the G4Ss. Why are these stocks getting approached now? When there's that uncertainty? Well, the obvious reason is because there's a lot of cash out there burning a hole in people's pockets, and there's prize assets that are available because we, the investment community, continue to be too timid, I would argue, and too bearish on the intrinsic value of UK stocks. So that's sort of a summary, really, of my sort of bit of a rant, really. Well, you're used to we're probably in the same season, actually, aren't we, of the political party broadcasts and all the rest of it. But there you go, making the case for UK equities. I've not talked about specifics of my fund, and that we don't want to get into too much marketing. But if I just give a couple of points on what I'm trying to do and maybe how that differentiates with other funds that you use, there's loads of different ways to cut the cloth. And I do think what is an interesting point generically to make out is that over the last decade, really, there's been a real narrative about, are you value or are you growth? Are you a roundhead? Are you a cavalier? And never the two should meet, sort of thing. And I think that's too simplistic and is almost symbolic, really, of what we see in society, politics, etc. Very extremes. There's no shades of grey. It's got and I think that's too dogmatic, too rigid. That I am a contrarian investor. I'm more of the value orientation. I don't think that's particularly controversial. Why would anybody be anything other than a value investor? Arguably, why would you overpay for growth? But it shouldn't be mechanical about just assuming mean reversion and buying everything that's optically cheap. You've got to kick the tires. You've got to do scenario analysis, try and make sense of the structural headwinds, and try and figure out, is that priced in or not? So for me, the hunting ground should always be for new ideas that you're building up of a more value orientation. When the sky is grey or raining and the market is distrustful of a stock and maybe double counting, maybe putting a low valuation on distressed profits and cash flow, that's the opportunity. And loads of times I'm way too early. I misdiagnose the extent of the headwinds. But in a portfolio, I can afford to be patient. I can do that. because portfolio construction is not about having 40 stocks that are all winners, all doing great things every day, switch on the screen, they're all lighting up, the market loves my stocks, I love my fund. That's not how it is. And in the stress that we've endured as investors over the last 9 months, people's time frame comes in and everybody wants to be on the stocks that are doing well that day, and you can get whipsawed, and therefore portfolio construction is as important as stock picking, and it's having that cohort of stocks that you're wrestling with, you're engaging with the management, you might be trying to change out the management, and then I won't. This is not a recovery fund that I run, but those sorts of stocks, if we've wrestled with them over 3-5 years before they've even got over the starting line, then I'm not going to give up on them lightly after the first flush of outperformance as the madding crowd maybe discover them. And therefore I will run my winners for longer, maybe, as long as operationally they're still doing what they say on the tin and the cash flow is tracking the profit recovery. And that's kind of, if you like, kept me out of trouble, given me the air cover to be more patient than the average for my next vintage of recovery stocks. And that's how I try and blend to get that balance in a conviction fund. That's what we're about. So, I mean, the traffic lights, the frame of this I've nicked from one of my investments, 3i results. They had that, and I thought that's quite good. I'll use that myself. but just directionally, that's trying to show you that within the portfolio, in that first lockdown, the smash that hit the red zone severely impacted COVID victim stocks. So I've had over 10 stocks fall at one point over 60%. I mean, ordinarily you'd think, oof, that's going to cause a lot of trouble and strife. But the portfolio has done a good job, risk adjusted, managed to outperform, keep my nose ahead. And why is that? Because it's that balance. But just like coming out the financial crisis, I'm very excited about some of those most disruptive stocks in the amber and red. And we did take part in some of the fundraisings and oversized them. And, the likes of Wetherspoons, they'll come out a winner. Whether you got a view on Tim or not as chairman, his business, will come out of this well. It's well invested, great proposition. M&S, slightly more controversial. Everybody's got a view on M&S, but actually, as an incumbent that's had failed really for the last 20 years, and it knows under its new management another few years like the last 20, and it's dead. So actually, it like a lot of businesses in the UK, I've been very impressed that managements have really gripped it, and it's sort of never the same again, and have accelerated change in a matter of months that ordinarily would have taken years. So they're not going to die without trying. They're swinging the bat, and they've certainly got an opportunity to win in food. So there's lots of opportunities. So. And then, on the green, yes, there's those businesses that are more resilient, that are operationally have done a good job through the COVID crisis, and that's great. That's the bedrock in the portfolio. But you don't go buying more supermarket stocks in the bog roll trade in March, April. Funnily enough, now I think some of my stocks like Morrison's look far too cheap. Partly because they reside in the UK, partly the market seems to be overly concerned that that the uplift you've seen in sales through COVID, which is akin to coming off rations in the 50s, I suspect, that'll dissipate next year. So that's the challenge, and I think the likes of Morrison's will come through this and show actually they've developed an online business through different channels in double quick time, and that as the excess costs fall away, that profit is sustainable. So, I think that's an exciting opportunity from here, whereas you wouldn't have gone out and bought more necessarily in the height of fear in March, April. So I just sort of think I've that can differentiate from other funds that you use and can be blended to give a solution for you and your clients. And so by definition, in a focused fund of 45 stocks or so, you've got to be doing something different from the index and from other funds that you compete against. And we're unapologetic about being UK stock pickers, so all of the fund is in UK listed stocks. I'm not going to do any sneaky overseas listed investing. That's not my gig at all. Nor do we use derivatives. All of the income is organically generated. And obviously, yes, we've had a big hit to dividend income this year as businesses have needed to preserve liquidity to get through this crisis. But, very encouraged to see already a lot of stronger businesses come back with dividends and also pay in lieu some of the deferred dividends from earlier in the crisis. So, the culture of dividends as an important component of your total return is still very much in place. And the prize is from this low level, having had a reset at the end of this cycle, what kind of dividend growth can we achieve over the next few years? And, dividends will lag the recovery in profits. But from this base and the yield that you're already getting on the UK market, I think that is an attractive part of the total return proposition from here.
Thanks, Richard. We're just going to gather a little bit more insight now from you with some follow-up questions. You invest with a total return mindset for clients, and the UK market is renowned for its dividend yield, which form part of that. Clearly, there's been a large reduction in dividends this year due to the pandemic. So what has that meant for the fund, and what lies in store moving forward on that front?
Yeah, it's responsible for running income funds. Income is a key component of the total return proposition that we're trying to deliver to clients. However, it shouldn't be, obsessive. And I want to capture capital growth as well. So we've always constructed our portfolio with the yield at the portfolio level. So I do not sort of screen and say every stock has to have a minimum yield, because if you're hunting just in the UK market, that's quite narrow, I think, and that would be quite inflexible personally. So we have a blend where we've always had some stocks with no dividend, even in good times. Hopefully the engine room of our portfolio will be stocks that we bought when they were out of favour on a higher yield, but now have re-rated. So the current yield might be quite low, but the dividend growth is doing a great job. But then occupational hazard, what an income manager needs to be is selectively brave to go out on the ledge and buy higher yielding stocks that the market is fearful of and thinks those dividends are not sustainable. And it's getting that blend that we try and do. And what we're trying to do is smooth the distribution as best we can through a cycle. So post the financial crisis, yes, dividends across the market fell by a third, but our fund over that sort of 2-year period, distribution fell more like 16%. This time round, it's a real bone shaker, clearly, because the economy just stopped overnight. So, whether across the market dividends fall 40 or 50%, it's of that magnitude. And given that where the valuation of the market is, we've still got over a 3 yield on the market, even after those falls. For our funds, we should do better than that fall across the wider market, because what you're trying to do late cycle, which was the case last year and the year before, is dab on the brakes. So, I've not owned banks for a decade and I had very little oil. Not that I had my crystal ball out and thought COVID and all the rest of it was about to come around the corner, but, that has at least, allowed us to not bear the full brunt of dividend cuts. So dividends, it should be a real important part of the total return that you can get over the long run from UK equities. And despite this COVID hit, that is still a valid statement. And but we always have a cyclical downturn when dividends get reset. And in a lot of cases that was necessary. Get the monkey off your back, move on, invest in your business, get on the front foot. And so it's, we want to capture that attractive dividend rebuild and growth from here. But, we've got a useful yield starting point.
You've mentioned you try and deliver an all-weather core portfolio for clients with a contrarian mindset. Now, there have been a number of the largest 20 stocks in the FTSE by market cap that you haven't owned for some time, such as banks, miners and large oil. What drives those active decisions?
Yeah, I mean, I want to, when you say all-weather, I mean, I want to achieve an attractive total return, risk-adjusted over rolling 3 and 5 years, but I'm certainly not clever enough to be able to figure out how you could outperform each quarter or every twist and turn of a market. If you try to do that, you go mad. You'd be just chasing your tail. So you're trying to construct a portfolio with stock-level convictions, and within that, as you build up, there could be some big sector positions, and certainly in my 45 stock portfolio, I'm zero weighted, as you say, in banks, and have been for a decade. Zero weighted in mining, so that's a pretty lively score draw actually. But it's not being too bothered about what other people own or what's a big part of the index. You're trying to figure out what you and your team have an edge over. What the market might be missing, and where you want to allocate your client's capital, where you've got that level of conviction. So as long as other stocks that I do own, whether it's in pharmaceuticals or sports service or engineering or insurance, etc., if they're doing well, then I don't need to be too bothered about iron ore rocketing up and miners going to the moon, although I'm still pretty bitter about that. But anyway, and on the banks, obviously, you got to kick the tires. You got to keep very close to what's going on. And fair play to the businesses. They've missed the last cycle because they needed to rebuild their capital. And cometh the moment, you would hope that they do a job for the economy and don't foreclose on too many small businesses, and can lubricate the funding that the government's supplying. Whether that means they're attractive investments, clearly at this sort of depressed valuation, they can move very quickly, as we've seen on the recent rally, and quite rightly, if you're on 0.3 times book, it doesn't take a lot to shift the share prices. But I wouldn't buy them just for a trade. I'd want to get comfortable with the absorption of the magnitude of bad debts that's coming their way, really. I think that's important. So you kick the tires on all the stuff that you don't own, but it doesn't mean to say you have to buy anything, in Japan, I suspect not owning a bank for 30 years has been quite a good career move. So, we're alive to opportunities, but in my portfolio, I tend to hunt lower end of the FTSE 100, top end of the mid 250. So within the mega caps, top 20, apart from the farmers and the Unilevers, etc., we don't tend to have that many. It's about 12 of the top 20 that we have zero weight in. So we're much more truncated. So we're larger cap orientated funds, but outside of the mega cap, if you like.